Most trading losses don't come from bad luck, they come from the absence of a plan. Professional traders treat every position like a business venture, and they write a business plan before putting capital at risk. That plan answers 5 questions. What is the trend right now? Where is the next resistance zone? Have any hallmark actions appeared? What is the asymmetric reward relative to my risk? And under what conditions do I exit? In this analysis we break down a framework that uses trend slope, price space mapping, false break patterns, and explicit risk-reward arithmetic to turn discretionary trading into a systematic process. We then apply the method to a current crude oil reversal and show how a disciplined plan creates an edge before the first contract is ever entered. Profitable trading is trend following, but not all trends are equal. The first step is to identify 3 characteristics. Direction, up, down, or sideways. Strength, steep trends move fast and exhaust quickly, shallow trends grind but may persist. Slope change, a strong trend often accelerates from a low angle to a steep angle before reversing. We can collapse all 3 into a single visual heuristic, the clock direction. On a clock face, 12 o'clock is vertical up, 3 o'clock is flat, and 6 o'clock is vertical down. A healthy uptrend moves from 2:30 toward 12:30, gaining momentum. Entering near 3 o'clock offers no edge, and chasing after 12:30 often hands the position to latecomers. The goal is to capture the middle of the move while the clock is still winding forward, and exit when the angle becomes unsustainable. Subjective clock readings can be replaced by a simple slope calculation. Take the price change over a recent window and divide by the time elapsed, then scale by the average daily range to make the angle comparable across assets. The resulting angle approximates the visual slope. Empirically, angles below 10 degrees signal a weak trend, between 15 and 45 degrees a healthy sustainable trend, and above 60 degrees an unstable blow-off that often precedes a reversal. This formula gives a consistent, testable measure of trend strength. It also lets you backtest how often a steep angle actually led to a trend change, validating or falsifying the clock heuristic. Once the trend direction is known, the next question is how far it can run. Every downtrend leaves behind zones where moving averages clustered and price consolidated. Those zones become resistance when the asset reverses. The process is straightforward. Find the last meaningful downtrend, identify points where the 20-day, 50-day, or 200-day averages converged and traded together, and measure the vertical distance from the current price to each cluster. The nearest cluster is the first profit target, the farthest is the stretch objective. This space quantification tells you whether the potential reward justifies the risk before you commit any capital. If the nearest cluster is too close, the risk-reward will be poor, and the trade should be skipped. Markets do not reverse silently. At the end of a trend, extreme volume, price gaps, or false breakdowns appear, what we call hallmark actions. A false breakdown occurs when price briefly pierces a prior low, traps late sellers, then snaps back above the low on heavy volume. It signals that the selling pressure is exhausted and a reversal is likely. Similarly, a gap up after a prolonged decline shows sudden demand overwhelming supply. These events provide natural reference points for entries. Place a buy order just above the false break bar's high or the gap's close, with a stop below the extreme low. By waiting for a hallmark action, you avoid catching a falling knife and instead enter with the weight of evidence confirming a potential trend change. A simple moving average is the arithmetic mean of the last and closing prices. Its value changes every day because a new price enters the window and an old price drops out. The MA will turn up if today's price is higher than the price that just left the window, the deduction price. This condition, P_T_TN, is a mechanical signal that the average is rising. Many trend-following strategies use this property. Enter when the short-term MA turns up and price closes above it, confirming that the clock direction has shifted. If the condition fails and price falls back below, the trade thesis is broken. This rule removes subjectivity from the entry decision. A trade is only worth taking if the potential reward compensates for the risk. The standard risk-reward ratio divides the distance to the target by the distance to the stop. Professional traders typically demand at least a 3-to-1 ratio, and prefer 5-to-1 or better on high-conviction setups. This asymmetry means you can be wrong more than half the time and still produce a positive expectancy. Combine the risk-reward ratio with an estimated win probability to compute the expected value in dollar terms. Even a low win rate becomes profitable if the reward is large relative to the risk. This formula forces you to measure the opportunity before committing capital, rather than relying on hope. A trade plan must define exactly when to exit, both when you are right and when you are wrong. On the profit side, use the resistance zones from the space map as partial take-profit levels. When price reaches the first target, take a portion off the table and raise the stop to break even. On the loss side, if the moving average turns down and price closes below it, the trend edge has evaporated, exit immediately. This "what got you in gets you out" rule removes emotion. The plan should also handle the grind. If price meanders between entry and target without breaking trend structure, simply hold. The exit is crisp: target hit, exit; MA breaks, exit; otherwise, stay in the trade. To apply the framework, we look at Brent crude futures, which have provided a sharp reversal pattern this summer. In early May, Brent traded near 101. A 3-month decline brought prices to a low around 70 in early July, a move of over 30%. Since then, the contract has staged a fierce rally, gaining over 25% in 1 month to close at 90.12 on July 31st. This price path contains all the elements we need: a steep downtrend, a potential hallmark low with climactic volume, and a subsequent recovery that is shifting the trend clock from a 5:30 direction toward a 2 o'clock direction. We will examine whether a systematic trade plan would have captured this recovery while defining risk in advance. In early May, the short-term 20-day moving average was pointing toward 5:30 on the clock, a steep near-vertical decline. Prices were collapsing below the 50-day and 200-day moving averages, and the slope angle, using our formula, likely exceeded 60 degrees. Such a sharp move is unsustainable. By late June, as price approached 70, volume spiked, and a classic false breakdown emerged: a brief dip below 70 on high volume, followed by a rapid rebound back above 70 and the 5-day MA. This hallmark action shifted the short-term MA slope. Over the next 2 weeks, the 20-day MA gradually curled from a 5:30 angle to a 4 o'clock angle, and by late July it had reached roughly a 2 o'clock slope, a healthy, accelerating uptrend. The clock was turning, and the trade setup was forming in real time. During the 3-month decline, Brent built 2 notable dense zones where moving averages converged. The first formed in the second half of April near 95 to 100, when the 20-day and 50-day averages tightened before the final breakdown. The second is a longer-term cluster around 105, near the 200-day moving average that has acted as resistance in prior years. Measuring from a potential entry near 73.50, just after the false break and MA turn, the space to the first cluster is roughly $11.50, and to the second cluster about $21.50. These distances define the trade's upside potential. If the stop is placed below the recent low at 70.00, a risk of $3.50, the reward-to-risk ratios become attractive. With entry, stop, and targets defined, the numbers can be laid out in a simple comparison. A buy order near 73.50, triggered by the false break recovery and the 20-day MA turning up, risks $3.50 down to the stop at 70.00. The first target at 85.00, just below the lower bound of the April cluster, offers an $11.50 gain, a reward-to-risk ratio of 3.3 to 1. The second target at 95.00, deeper into the cluster, yields $21.50, a ratio of 6.1 to 1. Even a conservative estimate of a 40% win probability produces a positive expected value. This is the arithmetic that turns a subjective chart pattern into a quantifiable edge. The trade is now live, and price has already reached 90.12 by July 31st. The first target at 85.00 was hit, so a partial take profit would have been booked and the stop likely moved to break even. The remaining position rides toward the second target near 95.00. The exit rule is mechanical: hold as long as the 20-day MA continues to point upward and price closes above it. If the MA flattens or turns down, or if price gives a daily close below the MA, the trade is exited. There is no need to predict the exact top, the trend clock will mark its own reversal. This approach ensures that winners are let run while losers are cut quickly, the core principle of asymmetric risk management. A trade plan is not a forecast, it is a decision tree that forces you to measure trend, space, hallmark events, and risk-reward before you commit. The 5-step framework, clock direction, resistance mapping, hallmark recognition, risk-reward arithmetic, and exit discipline, can be applied to any liquid market. What matters is the consistency of the process, not the outcome of any single trade. Markets will always be uncertain, but a rigorous plan turns that uncertainty into manageable risk. We release new quantitative frameworks and evidence-led market analyses regularly. Until next time, plan your trade, and trade your plan. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.